Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Our webinar title today is Decoding Market Timing, Indicator Analysis versus Price Action Strategies. So my name is Shen Chu. I'm the moderator for this session. So today, our webinar will delve into how do we time the market. Should we use indicators? Or should we rely on price action to decode the market timing? So joining us today is Catherine To, which I'll introduce her in a short while. She will share with us how do we time the market. So disclaimer, whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you are solely responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. She worked in the semiconductor industry for 17 years, with the last role as Automation APAC Manager for Intel. She started trading in the Malaysian market part-time in 1992 and US market since 1997, and became a full-time trader in 2008. She has experience in stocks, options, CFD, Forex, and futures, and her core approach is top-down, from macro to industry to stocks. She uses a combination of fundamental and technical analysis. She is very passionate in trading psychology, as she believes that money management and psychology contribute 90% of the success in achieving consistency and in investment and trading. And she started Beyond Insights in October 2008, focusing on investment and trading education. So she's none other than Miss Catherine To, who is the founder and chief trainer of Beyond Insights in Berhad. So Catherine, it's good to see you here today.
Yes. Yeah, thanks, Shane, for the introduction.
All right, so we can't wait to learn from you about market timing. So I will just stop sharing my screen and hand over the control to you.
All right, great. Okay, can you see my screen?
Yes, perfect.
Okay, great. All right, welcome everyone to the seminar tonight. Today I'm very excited to share with you one of the topics that I think cause quite a lot of misleading or misleading interpretation, right? Which is indicator analysis versus price action strategy. So the focus of today's topic is what is the right way to time the market. There are actually many strategies in the market, and my role here is to help you shorten your learning curve. Okay. Right. So the objective of this session is to provide you an effective framework to approach the financial market so that you can reduce the learning curve and also optimize your success potential, right? After trading for 31 years, I have actually used many different approach. And I won't say that I wasted a lot of times on indicators because, you know, if you don't do it, then you will not know, you know, the pro and cons of it. But I have used it for many years to realize that it's actually lagging, and the best way is to use a price action. So I hope that my sharing with you will help you to save a lot of time, right? To focus on the right area instead of spending too much time on the indicators. So aligned with that, I want to share with you the challenge to challenge and demystify some of the common perception that technical indicators are the ultimate tool for market timing. There are also many trainers in the market, or even if you look at the YouTube videos, there are a lot of information sharing about indicators, technical indicators. So I will explore their strengths and the limitation. I'm not saying that you cannot use it at all, but if you want to use it, you need to understand the pro and cons, so that you don't use it the wrong way. So I will also dive into the essentials of market timing, right? I will contrast the differences between using indicator-based strategy and also price action, which is my preference strategy. Okay. I will also share with you other contributions, other contributors to the success in trading. Since, you know, a lot of you could be new to the market, or some of you could be experienced, right? In a short while, as we wait for more people to join in, I will launch a poll so that I can understand your experience better, so that I can really tailor the presentation, right? So for those of you who are on the chat today, right, I'd like you to also share with me right? Is there specific things that you're looking for as well, right? When it comes to market timing, feel free to type on the chat. Yeah. I will have a roughly 1 hour presentation. Then towards the end, I have about 20 to 25 minutes Q&A before we wrap up. Okay. I also have our senior trainer and coach here, who is a Kut, who also helped me to look at the chat, right? So because as I'm presenting, I may overlook some of the chat questions, but do focus the questions right on the topic for today. Otherwise, it will get very defocused. Okay, so are you ready? If you're ready, type yes on the chat. Okay, if you're ready. Yeah, I like to have more interactions rather than just one way, because I cannot see you. Right? This is a Zoom webinar, not Zoom meeting. I'm used to conducting both face-to-face and online. I like to see people's faces, yeah, so I can know whether you're engaged or not. Okay, great. All right, so let me get started. Right, there are various ways or various approach to timing the market. Okay? The first one, which is very popular among investor, right, is what we call based on valuation. This is typically used by long-term investor. And for long-term investor, there are two major types. One is value investor. The other one is growth investor. Okay, I'm primarily a growth investor rather than a value investor. Value investor, using methodology like what Warren Buffett used, they are very long-term and conservative. Most of the time, they need to wait for the price to be discounted a lot, right, before they come in. And based on the last couple of years of bullish market, right, other than the COVID-19 period, 2020, and also the 2022 period where there's a huge interest rate hike, which caused the market to come down. This strategy, you have to be very, very patient, right? So for value investor, they typically would like to look at valuation. There are many different types of methodology here. For example, the simple one where a lot of people use is using P ratio, forward PE, the PAC ratio, or they use the discounted cash flow payback period, right? So today's topic is not related to this, so I will not spend time because that is another big topic by itself. Okay. The second method is called technical analysis, which is mainly based on charting, right? They are poor technical analysts. That means they don't look at fundamentals at all. They just look at the chart and trade, right? So how many of you are pure fundamental? Pure fundamental. That means you just look at valuation, not looking at the chart. If you're pure fundamental, you type an F, okay? If you're pure technical, you type a T. And if you're hybrid, you use both fundamental and technical, you put FT, okay, fundamental and technical. Yeah? Do type on the chat so that I can get to know you more. Right, okay, so quite a lot of FT, fundamental and technical. Okay. Hybrid means you combine the above. I'm a growth investor as well as a trader. I trade all time frames, but my primary is my nature suits short-term trading, right? I'm a very active intraday trader for a long time. But because of my current, account size as well as my work nature right now, I'm getting very busy. So I don't spend as much time trading intraday, and I don't need to. So I have about 60 to 70% of my investment account in mid to long term, and 30 to 40% in short-term trading. Okay. So for both, whether it's long-term or short-term, I adopt both fundamental and technical. I screen stocks based on strong fundamental, and I time them based on technical, right? Later on, I will share with you my approach, right, why I do it this way. There's no, so-called solid right or wrong. You just need to know what you're doing. Okay, so let me move on. So this topic is purely focusing on technical analysis. And I'd like to share with you the two major approach on TA. Yeah, TA stands for technical analysis. On the left-hand side is called price action. Okay? Right-hand side is technical analysis. So what do we mean by price action? I prefer price action because it's cleaner and it's more powerful and more timely. And it's simple as well, right? Price action means you look at the reaction of the stock price to the key levels. So what are key levels? First, in order to adopt a price action approach, you need to plot a chart with candlestick, yeah, because candlestick is one of the price action methodology. Okay? And you need to learn how to draw support resistance. Like these lines are called support or resistance, depending on whether it's on top or below the price bar. If it's on top of the current price, it's called resistance. If it's below, it's called support. And there are many lines of support. And this diagonal line here, right, is called the trend line. So you can see that the chart is very clean, and you can see where the potential price action is, right? So what do we mean by price action? For example, right, this particular bar here, right, break out of a range, break out of this line, which is originally is a resistance, and now come back, test, become a support. And it also retest this uptrend line, right? So this is a potential timing for entry. That depend on your trading methodology, because whether it's long-term, right? If you're investing or you're doing mid-term trend trading, that means you keep for a few months, or you're doing swing trading, range bound, or you're doing intraday, your entry and exit approach will be different, right? So this is just a generic technical analysis. I like this clean-cut price action because it can help me to tailor my buy price better. Okay, for example, if I see that it rebound on this support, I can buy slightly above the support. I can put a stop loss below, and I can target a profit target. Like, depends on whether it's a long-term investing or a swing trading, right? So if you're trading for trend or long-term, you don't put a profit target, right? If you're trading for a swing, like range bound, then you put a profit target, right? It's very clean cut. And I can focus on the chart below, which is how the volume, right, builds up depending on the trend, right? Example, you can see, some of this spike in volume here, okay, based on green candle, which is a good thing because the volume is on a green candle. That means there are more buying volume. If it's come down on the red candle, if the volume spike on the red candle, that means there are more selling at that time, right? So I'm able to see the price action better. People may see that it's very simple, but it's very powerful. On the right-hand side, is on what we call technical analysis, right? Later, I will do a poll on how many of you are exposed to technical analysis. What is technical analysis? There will be some, indicators below, okay? And the price chart is on the top, right? Based on this, there will be some signals generated below on buy or sell. There are many indicators, which I will show you later on, okay? So these are two different methods. So let me share with you an overview for technical analysis first, technical indicators. So that at least you get some idea in case some of you are not familiar. A technical indicators is plot below here. You can see here, there's one of the popular indicator is called MACD, M-A-C-D, not McDonald's, okay, M-A-C-D. And another popular one is called stochastic below. Okay? So the indicators are designed to give you signals, right? What they do is, it's created by mathematicians, right, to use the price example, right? Let's say MACD or stochastic, they will at this point in time, at the particular point in time, they will use the last X bar, right? Last X candlestick, and employ what do you call that? Put a formula on it to derive a value, and this value will be plotted below. Okay, let's say MACD based on the formula for the last X day of the price above, it will plot a point below. Okay, same for stochastic. And based on this, they will use 2 points, right, which is connected to 2 lines to give you a signal. Example, one of the popular one is if the blue line cross the red line, right, is a potential buy signal. I call it potential. It's not a confirmed buy. Okay, potential buy signal. And if it cross the other way around, right, like this, the other way around, then it's a sell signal. Okay, that's what indicator is supposed to help you have the buy and sell signal, but there are a lot of limitations. Same for stochastic, as you can see here below. There's a range here. If it goes down below the color zone and goes back up, it's a buy signal, right? And it goes above the color zone, which is 80, and turn back down, it's a sell signal. So you see, a lot of beginners like this because it's a no-brainer. I just need to look at whether it's turn up and turn down, right? Yeah, people thought it's that simple, but actually in reality, when you use it, you'll know that it's not that simple. It's actually very tricky, and it's also not accurate a lot of times, right? So in general, the price, like on the second bullet here, the price data use a combination of the last X day candle, right? So they could be using the open, high, low, and close of the previous candle. But most indicator use closing price, right? Let's say I want to use stochastic. right? Stochastic, there's a 1433 parameter here. Can you see? 1433. The first one is 14. When it's 14, it means I use the last 14 days candle, right? And the default is closing price. That means I use the last 14 days closing price, right? And apply a formula to plot the graph, okay? Some indicators use volume as well, right? Most indicators use price, like stochastic and MACD are purely based on price, but later on you will see some indicators use volume, okay? And the whole purpose is, other than giving you a possible buy and sell signal, some of the indicator give you some potential trends, right? Whether it's a uptrend or downtrend, and also help you to identify a potential shift in momentum, right? That means when you look at the indicator, you know, okay, there's a momentum shift, right? Okay. All right. So the next section here, I'll be covering with you some of the most popular indicator, right? There are 4 different categories, right? There are 100 over indicators there. If you look at any charting software, a lot of times they have many indicators, and it's not possible for you to use all, because if you use all, your chart will be too tiny for you to see even one indicator, okay? Before I move on to explain the categories here, I'd like to do a poll to see how many of you have actually used some of these indicators. Okay. Good. Can you help me launch a poll? There's a multiple question poll here. You need to scroll down. Yeah, there are 4 questions here, so make sure you answer 4 of them. Okay, I want to know your experience as well, so I know how, you know, how much I need to explain. Yeah, can you answer the poll? I hope everyone see the poll here. Okay. I only have 42% responded, right? Still another more than half haven't responded. Yeah, please do that fast so I can proceed to the next section. Okay, so let me show you the stats here. Some of you have not traded. Some of you have traded more than 100 trades. Okay. So it's quite a wide variety of experience level here. Are you able to see my poll? Just curious whether the poll shows
Yes, I can. Yes.
the stats here. Okay. All right, there's 52% of you responded, right? So what happened to the rest? I know there's quite a lot of questions. Yeah. So let me just do a quick check here. There are quite a wide range. The second one is a lot of you have used moving average. The next most popular is MACD. Then Bollinger Band. Yeah, if you click on others, please type on the chat what are the other indicators that you use. Yeah, because I cannot put in 100, the poll will be too long. Okay, so please type on the chat if you use others. Yeah, at least I know what indicators you use beyond this list here. Okay, so we have beginners, intermediate, advanced, and majority of you are trading Malaysia market with some US. Okay. All right, so I will leave the poll on so we can continue to respond. There's only 56% of you. Okay, trade goal and awesome. Volume, AVR. Okay, volume is already considered part of it. Okay, just want to show you some of the, right, AQR, volume, relative strength, RSI. Okay. All right. Let me move this back. Okay, so because there are some of you who has not traded at all, but probably you have watched some YouTube video. So let me just explain first. Out of the 100 over indicators, they are classified by these categories, right? The first categories is called overlay. Why are they called overlay? Like example, one of the overlay is called moving average, right? And also the Bollinger Band. Okay, moving average is the most commonly used, but in this chart here, it shows Bollinger Band. Okay, you can see here. Some of you, based on the poll, are using Bollinger Band as well. The indicators that are called overlay means the indicators are on top of the price chart. Example, you can see that the Bollinger Band sits on top of the candlesticks, so they can view it together, right? And parabolic SAR is a dot on the screen. So later on, I will have a demo on the actual live chart, so you'll be able to differentiate the few of this and understand the pros and cons of the respective type of indicators. For now, you just need to understand the category of the indicators first, without me explaining each indicator by itself. So at the bottom here, you will see that these are the 3 examples of overlay. The second, the rest of the indicators are put below the chart itself. Okay, yeah, below the chart itself. So the like these are the popular one, is called RSI and MACD. These are called momentum indicators. Like the name implies, it measures momentum. What is momentum? Momentum related to the rate of change, right? How fast is the momentum built up for the stock to go up, or can be downtrend, like can be momentum on the way down. So RSI has a formula that's very unique. Like it calculates what we call the rate of change, and also how fast it take the, for the last X day candle, let's say the most commonly used RSI is RSI 14, right? It takes the last 14 days price to see what is the rate of change from 14 days ago to now. Okay, divide the increase divide by the decrease on the last 14 days. So you can know like how many candles actually go up compared to how many candles go down. It has quite a complex formula, which is not easily digestible. But in general, if the momentum is up, right, then you will see the RSI trending up and it will be above the 0 level. Okay, if the momentum is dropping, then you'll see the bar coming down. Okay, so at one glance, you can see whether the momentum is up or down. Why do we need that indicator? Is usually when there's a choppy market, you see green, 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 red, then green, red, 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 then blue, and then green again. You may not be able to see, unless you are experienced, to know whether how's the momentum. Is it up or down? Okay, so on average, whether it's up or down, that's what these indicators is attempting to tell you. The third type of indicator is called oscillator. Oscillator means the indicator gives you a range. For example, this one, stochastic, RSI, CCI, is called oscillator, right? So oscillator means it oscillates around a range. So when it goes above a certain number, it will give you a buy signal, right? Yeah, example here, you can see a color zone. So let's say most of the indicator work like this. It goes below the color zone and go back up into the color zone. That is usually a potential buy signal. Okay, and if it goes above the color zone and come back down, then it's a potential sell signal. There's also another interpretation, which is below the color zone, right? It's called oversold. That means too much selling. And above the color zone is called overbought, too much buying, right? Bear in mind that overbought doesn't mean it's time to sell, and oversold doesn't mean it's time to buy. Okay, you actually need to look at the overall trend. It just tell you it's just too much buying, right? So there could become a point in time where the it will become exhausted. Okay, then it may slow down. Okay. So most of the time there's a range between 2 levels, but there's also one indicator that shows a center line, right? Center line, like MACD and ROC, they have a center line which is 0. Okay, so they are a momentum change signal when it goes above 0 or below 0. Right? That means if it goes, let's say for the ROC indicator, which stands for rate of change, right? If the rate of change for the stock is positive, that means let's say today compared to 14 days ago, right? If a positive change, then the indicator will show above 0. And if the rate of change, today's price compared to 14 days ago is negative, right? Percentage change negative, then it will go below 0. Okay, so this is the same for MACD. Yeah. Yeah, so that's why it still oscillates around a certain region. And the last type of indicator are based on volume. They use the price formula and together with the volume formula to give you a signal, right? So these are the 3 types. The first type is the more popular one compared to the rest. It's called unbalanced volume. So indirectly, it came up when there's a green candle, it times the volume compared to the red candle, then times the volume. Then it derives a formula to let you know overall, is that a higher volume going up or higher volume going down? right? So you can see that a lot of this formula has its own benefits, right? It actually attempts to give you a signal, right? Yeah. So I will not explain every one of this in detail because each formula, okay, each of these indicator and how to use it properly can be a half an hour to 1 hour presentation, right? And this is only about a 1 hour plus presentation, right? So this presentation here is to give you an overview of all this, yeah? And I will show you a few of the popular one and the limitation. Okay, so let me move on. Okay, so now after sharing with you all these different, let me see some of the chat questions here. Okay, the Bollinger Brand. Okay, so there's a question on the, before I go to the specific indicators, right? Later on, I will show you the chart. Then I'll show you there's a settings, right? Some of the questions is related to this, right? Which is Bollinger Band using EMA or SMA. You can set it whatever you want, okay? If you know how to set it. Same for RSI, the typical one is 14, but you can also change it, okay? So now let me share with you the drawback first, right? The drawback of technical indicators. So the first one, show you based on Tenaga shares here. Okay. I like to use just simple indicators and the rest I rely on price action. Example, this is called the moving average, right? There's a moving average, there's a setting, and I like to use EMA rather than SMA, exponential moving average, react faster to the stock price, right? Simple moving average is, okay, let me just show you an example here. There's a red color, green color, and the purple color. The red color is EMA 20. Okay, EMA 20. So let me just explain a very layman terms to you so you can at least understand how indicators work for those of you who are beginner. Right? The red line is EMA 20. I'll explain to you the SMA first. Simple moving average. Simple moving average. What the simple moving average do is this particular dot of this line is derived based on adding the last 20 days because it's a moving average 20. Means I take the last 20 candle, right? If it's a daily chart, it will be the last 20 days. If it's a weekly chart, it's last 20 weeks. Okay, if it's a minute chart, then it will be the last 20 minutes. Okay, so it's based on candle and not based on the actual, depend on how you set up the chart. So this line, I take the last 20 days and the common setting is closing price. I just add up all these candle closing price and then I divide by 20. I get an average, right? Then it plots here. Okay, so the previous day will be the previous 20 days. So when you see it going up, means the average price for the last 20 days has been going up recently. Is it good or bad? On average. Why do we need this kind of indicator? Because now this one is obvious. We see a lot of green candle keep going up, right? But sometimes you have green, green, then red, red, green, green, then red, red, green, green, then red, red, right? And it could be going higher, but in between there's some red. Then you want to know on average, is the closing price higher or lower? Understand? Right? That's the purpose of the moving average. But when the stock move fast, for example, let's say sometimes you have a long green bar, sometimes you have short bar. Do you think it will make a difference, right? Long green bar versus short bar. Okay. So when the price change very fast, the simple moving average, right, is too slow to react. And that's why I prefer to use the EMA, exponential moving average. Exponential moving average put more weightage to the latest candle, right? The last few days candle compared to the candle 20 days ago. Okay, so that's why it reacts faster to the price changes. So why do we have a 20, 50, and 200? 20 is used for shorter term trend, and 50 is the mid-term trend, and 200 is the longer term trend, right? Different people may use different settings, but these are the common one in the industry: 20, 50, and 200. All right. So there are many ways to use it. One, you can see it. Okay, what's the trend? We ask you, what is the trend? Then when it's above the moving average, you say the trend is up, right? When it's below, then you say that, like here, the trend is down. That's one usage. The second one is when there's a crossover. You can see the 20 cross 50, right? People see this as a bullish signal. Okay, so that's one example of the moving average. So the one below here is where I will explain to you later. Right? So in general, most indicators are derived from the last X candle closing price. And because of that, right, this is the most important point for you to take note. Because it is derived from the last X closing price, it is slow. It's called lagging. Okay. Example, right? The EMA 200 is very lagging because it adds up the last 200 candle, right? Even though current few days, so let's say the last 3 days is very bullish, but I take last 3 days closing price and I add on to the last 200, right? Yeah, to the last 197 candles that is earlier, that is bearish, then it was not turn much, right? So this is where you need to understand, because a lot of people use indicator without understanding this aspect. Okay. Then the second part is take up space in the chart. Many people find that one indicator alone may have some drawback, so they tend to add a few because each indicator has a different pro and cons. Like MACD measures momentum, right? RSI measure the rate of change, and stochastic look at the breaking out of a range. Okay, or when you're oscillating, it tells you when it's about to rebound or when it's breakout of a range. So it has different purpose. So other people add different indicators, but when you add too many indicators, what happens? Your stock chart become very tiny, and you cannot see the price action. You cannot see the bar, whether how big is the bar, right? And correlated with the volume, right? That's the reason why I don't like to use indicator at all. I have nothing below. Okay, the one that I use is a simple EMA because I know how to look at the candlestick and price action. Okay. Too many indicators sometimes can give you conflicting signal. Right? Some say the buy and some may say a sell. Right? Then what do you do when it's conflicting? Let's say two says buy and one says down, or two says down, one say up. Do you have to have all the indicators aligned? When all the indicators align, usually are too late. The chart is very bullish. That's why they are aligned. Right? So because of how the indicator works, I actually study a lot of the indicator formula. I just have interest in it when I first started trading, right? So I really study MACD formula, RSI, CCI, stochastic to understand why it worked that way, how come it turned this way, and why is it lagging? Yeah. And many signals that the indicator give, like some of them is not just looking at the turning point. There's something called divergence, right? Which I'll show you in the chart later. Even divergence is redundant. Right? To me, when you know how to look at the price action, you act and you understand the formula, you can predict or anticipate how the indicator will turn. For example, I can anticipate when the MACD will cross over, even without plotting it. Yeah, because I understand how the indicator works. So because of that, it will be redundant to you. Okay. Yeah. So understand. So let me go on to the last point. Right. Most of the time, even though the indicator gives you some signal, you still need to confirm with the price action, right? To have the precision in your entry, stop loss, profit target. One example is, let's say this particular signal, right? This particular signal tells you it's a buy. Example here, let's say if you use this signal to buy, then exactly what price to buy. That's what indicator cannot tell you. Okay, it just tells you a signal, okay, this is a potential buy area. But what price to buy? You still need to draw the support. You still know where are the bounds. And to slightly above support is where you buy. Then where is your stop loss? How do you look at stop loss? Indicator cannot tell you where to put stop loss. Indicator cannot tell you where to put your profit target. Like it has to wait until the turn. So because you have to wait until it turns to get up, for example, here, right? There's a potential turning signal, right? MACD, the blue color haven't crossed the red color yet. But when it crossed down, it's a sell signal. Okay. But are you going to look at the chart 24 hours to see whether, or during the market open to see when it turned? Then you have no life, right? Yeah. So that's the reason why if you want to have lifestyle trading, you don't want to be completely relying on the indicators. Indicators is just a simple one just for you to monitor. Okay, so you need to know the price action to know whether, okay, now I should take partial profit or not, right? Or now I should just let it run, move up my stop loss. Okay. Yeah. So let me move on. So now I hope that you get some rough understanding of this. Okay, for those of you who, that's very good. Now I get 99% of you answer the questions. Okay, right. So now I'd like to show you on the live charts. Okay, so can we do a poll? Can we do a poll on how many of them have used Trading View before? Just a yes/no question. Yeah. Yeah. Can we launch a poll on it?
Okay, I've launched. Let me just recheck again.
Yeah, but make sure you capture the poll answer just now. Do you capture?
Yep.
Okay.
Can you see the poll?
Wait, I cannot see the launch. Okay, I see it. Okay, let me see investment. I didn't see your yes/no poll.
Hang on now.
Yeah. Probably need to end the first one.
I think you need to end the first poll.
Yeah, need to end the first one.
Ended already.
Yeah.
Launch. Okay, launched.
Okay. Okay, so looks like a lot of you are using TradingView. Okay. You don't have to follow me on this, but I just want to show to you some points here. I'm going to show you one chart over here, which is the Tenaga. Okay, so I'm using a daily chart, and I have add in a MACD and RSI, which is a popular indicator. Okay, right. So based on this chart here, which is a 1-year daily chart, just look at my screen first. Right, you can see that the trend is very nice, right, on the moving average. Okay, and then it broke the other day, right? So last Monday, there's a big jerk reaction, both in the US market as well as the global market. Okay, so you can see here, the overall trend is up. So by right, you should not be getting out. But let's look at what the indicators say, right? I zoom in further here on MACD. In general, there are a few ways to use MACD. Okay, so let me show you the MACD have the settings here, right? These are the settings. If you're experienced, you can tweak it. Otherwise, most people use the default, which is 12, 26, 9. Yeah, it's the default. And this 12, if you go in to understand the formula, this stands for EMA 12 line, and this is EMA 26 line, and this is a smoothing line. Okay, it actually used 2 moving average, right, to plot the line. Example, these are the 2 lines here, and then there is a signal line crossover to smooth it, to detect the momentum, right? So you may not understand what I say right now, but just attempt to understand the usage first. Okay, later on, if you cannot, I will explain a bit of the limitation that is because of the formula. Okay, yeah, you can see here, majority of the usage of MACD is when the blue line here cross the yellow line. Right, most indicators like the blue line cross red line or the yellow line here is an indicator of the buy signal. But let's look at this, right? When it triggers this buy here, it's flat. Can you see here? There should be no signal. The Tenaga share is flat. And please write this down, right? If you want to write some notes here. Most indicators give you false signal when the stock chart is sideways. Yeah. When the chart is sideways, and also sideways is one. The other one is when it's in a very tight range. Tight range, let's say, right, this is wide range, this is tight range. The tighter the range, the more false signal you get. The more false signal you get. So let's look at this. When it's a tight range, you will see a lot of buy, sell here. You can see here. It will turn here, turn there, right? Ask you to buy, sell again, right? Until here, it asks you to buy, then here it asks you to sell again, right? Then this one asks you to buy, sell, then buy back in. Okay, yeah. All right. Okay, yeah, thanks. Good. Yeah. So, but if you look at the bottom here, right, only this particular one is a more accurate signal. Okay, when it started to move, right, can you see? But there's a lot of zigzag here, but only this part is accurate. But only this signal here. However, can you see it asks you to get up here? Why does it ask you to get up here? Because it entered a sideways range. When it enters a sideways range, then it gives you false signal again, right? If you have big candle, big range, then MACD is more accurate, yeah, compared to when it's in a tight range. Like example here, it asks you to get up. Why does it ask you to get up? So most people don't understand why indicators turn. Indicators turn is as a result of the price change. When the candlestick drop, normally it will trigger. Okay, sometimes you have one candle drop like this, and when it drop percentage-wise, drop enough. Although you see the candle is quite small, but percentage-wise, because this is a cheap stock, okay, so it's not like $100 stock. So even a 10-cent, 20-cent move, right? So for let's say a $10 stock, right, $1 is already 10%, right? $1 is 10%. Okay. So when you have a small drop here, it triggers a signal for the MACD that there's a drop and it asks you to get up. Okay. If you get up here, you just miss the trend, the bigger trend that is still up. Okay. Then over here, it asks you to get back in. Why it asks you to get back in? Because there's a candle going up, so it asks you to get back in. Okay. Then over here, can you see here? Even though it's supposed to be sideways, sideways is supposed to do nothing. right? It's just a sideways trend and the support has not broken, right? If you draw a support here, okay, sorry, my lines are already there because just now I hide my lines. So these are my price action line. You can see when you draw a support here, you know that the support is still intact, right? The support is still intact. Support is still intact. I purposely hide my line so that you don't get confused between the two, right? So it's just going sideways. You're not supposed to get out of the trend. Yeah, but the MACD tells you the trend momentum is dropping. And what do? Should you be getting out? Right? In general, it's just say momentum dropping. You need to confirm with the price action to know whether you should go up. And if the trend is still nice, you should not go up. Okay. Then over here, I give you another entry signal again over here. Right? And that's because of the consecutive candle going up. That's why the momentum goes back up. Okay. Then over here, you see a couple of red candles. Because there's a couple of red candles, based on the MACD, right? It's taking the last X candle computation. So when you see a series of red candle coming down, it's the signal of momentum dropping, right? That means the last few days, momentum has dropped compared to the last X day. So it gives you a signal that you should get up. But if you look at the chart on top, should you be getting up? Yes or no? You should not be getting up. Okay, but it tells you here, if you use MACD literally, it say get out here. Okay, so when you get out means what? Get out at market price. Okay, but that's what it's supposed to tell you. Then when do you get back in? You're supposed to get back in when it turns back and go back up again. Yeah, but the chart has not what do you call it? This is the trend has not completely end, but it does tell you something, which is the momentum is dropping. Okay, so this is called a divergence here. Can you see the MACD? There's a top here going down, the mountain top. Right, this is higher, this is lower, but the stock price is going higher. This is called divergence. Yeah, divergence. This can be a potentially leading indicator compared to lagging. That means when the stock chart is going higher, the MACD is going lower, which shows you the momentum is dropping. Be cautious, right? The reversal may be coming, but it's no guarantee. It just tells you that the momentum is slowing down, right? Yeah. But if you are experienced, right, you don't have to rely on this. I will know that MACD will behave this way. Why? Because, can you see here? We look at relative high low. This is a much higher mountain, like much higher high. But suddenly, the next high is not so high. Which, from the chart, you know there's a momentum weakening. After that, you see so many smaller candles, you know there's not enough momentum. Small candle means you wait for me, I wait for you. Okay, yeah, you can wait and see, right? Nobody is having a conviction to buy or to sell, which is another representation of lack of momentum. So when you see this candle, lack of momentum, you will know MACD will drop because MACD measure momentum. So do you really need MACD to tell you the momentum drop, right? Why MACD can tell you? Because it measures the percentage change on a daily basis compared to the last X day. Okay, but if you look at it visually, you would know, if you know how to interpret the candlesticks, how strong is how bullish is the candlestick, right? And you know that it's for many days it has been sideways. But from the candlestick, you can see whether does it break the support. If it doesn't break, you're okay. You're just more cautious, right? Why are the momentum slowing? And if you look at you would dig into the news, right? Maybe there's a macro news, maybe there's an economic announcement coming out. That's why it's hesitating. It may not mean it's back. It could be just wait and see for some announcement, right? And if the announcement is bad, then it will drop. But if the announcement is good, then it will go up. Are you following so far? Does it help? Yeah. Okay. Yeah, some of you are asking whether need to buy real-time data. Yes, I purchase real-time data. Okay, because I do monitor Malaysia stocks, even though my primary trading is on the US. 30% of our students came from Malaysia stock market when they joined our class. Yeah, because our class cater for both Malaysia and I mean it's fundamental, it's the same whether you trade Malaysia or US, right? Yeah, so it does apply. Whatever we cover here apply to any stock market. To use TradingView, you need to subscribe to the respective country data feed, yeah, including Bursa. Okay, so can I stand here? So here, without the MACD trending down here, when MACD goes down, it shows momentum dropping. I don't need this to tell me because from the chart, I know it's momentum dropping. Yeah, can you see it's making a subsequent low? The high is getting lower, lower, lower. Okay, so I know momentum dropping. What MACD cannot tell you, or any indicator cannot tell you, is the price action here. There's a sudden drop and a sudden bullish recovery, which is a V-shaped rebound, which is typically a positive sign. right? Just pure looking at indicator cannot tell you that. And that's why I don't like to use a lot of indicator, because you see, if I minimize all these indicator, right, I can see the price bar better. I can see it longer. I can see more clearly what the chart is attempting to tell me. Okay, if you look at it, not sure whether some of you know, right? This is called a head and shoulder pattern, right? This is a high, next one higher. After that, lower high is it's a bearish reversal. That means usually it's a signal for down. Okay. However, I want you to understand that it just tells you the current price based on whatever market condition right now. So when there's a new announcement, things that change, right? It could be another what do you call that, bad news or another good news, right? It can change the direction, right? That's why don't look at technical analysis as, oh, how come it's not accurate or accurate. Okay, when there's an announcement, then it will change it. Okay, the next price action if it's a big market mover. All right, for example, today there's a CPI announcement. Okay? CPI announcement, and the inflation for the US is lower than expected, which is usually a good news for the overall market. Okay, but if people already buy a lot, right? If it's already very bullish before that, people could sell on good news. Okay, so those are the one that comes with experience. Yeah. Okay. Does it help so far? Are you able to follow so far? Type yes if you can understand. Type lost if you're lost. Okay. I know some of you are very new, so this could be a bit advanced for you if you're totally new. All right, so let me show you another interesting indicator here. I'm going to remove the MACD first so that you don't see so many. Okay, let's look at RSI. Right, RSI is an oscillator. Right, the way it gives you the signal is when it's example here, right? This is go down below 30, right? It range between 30 and 70, right? So go below 30 and go back up is a potential buy signal, like in this case, right? But it would be better for me to know what happened, right? The candlestick reversal happened here. And because of what I did, right? This is because of a jerk for the US market that impact the whole world, okay? So then I will know, okay, is this affecting Malaysia stock? In fact, this is, if you understand what is going on, what happened here, it would be a great buy for Tenaga share at that day. Because the event has nothing to do with Tenaga. Okay, yeah, nothing to do with Tenaga. But Tenaga go down because the market is affected by 40% based on macro, 30% based on the industry or sector, and only 30% is stock specific. Okay, so then you don't straight away go in just because this indicator turn. Because overall, the trend is still up or down. Is the trend still up or down based on the recent? Yeah, it's like its overall trend is up because it's still above the EMA 50. But if you look at the momentum is actually not good on the last few, right? Let's say if I draw a trend here, like it's actually still in a downtrend. It still haven't recovered that. Yeah, it has not recovered. Okay, but I know these are the key support. If it doesn't break the support here, yeah, it is still okay. It can be coming down here and rebound. But if break the support here is not good, because break the support and break the EMA 50, right? That's like going back downtrend. Yeah. So you need to know where to look for. But indicators doesn't give you precision. Okay, because here the RSI is asking you to buy here. Why does it ask you to buy? You can see that it's lagging because this turn here is all because of these two candles. You don't need the RSI to tell you that. Do you agree? Yeah, but people thought that it's holy grail, right? It's not. Yeah. Okay, just let me just cover a little bit here, and let me reset my chart here. Yeah, and here it tells you overbought, right? Overbought condition. Same for stochastic, but you see overbought. It has been overbought here, but it's still going up. Right here, overbought, still going up. Okay, so in the end, you still need to look at the price action to know whether you should get out. So to me, why waste your real estate on your space on the chart here? Okay. So if you know how to look at this, all these indicators are redundant. Okay, yeah, so then I can save another space. Right, in general, the RSI, there's also another meaning when it's above the center line, higher momentum, below the center line, lower momentum. Okay, and when it starts to drop, right, that means momentum dropping because it measures the rate of change. Okay, so I won't be able to go too detailed on all the indicators, but let me share with you one last one. Over here, pretty popular is the stochastic. Stochastic. Yeah, stochastic is pretty interesting. And let me, yeah, you need to smoothen it. Otherwise, it's, yeah, look at the indicator here. Can you see that's very jerky, right? It turns very sharp corner turning. Yeah. So when these are the parameters that you can tweak. You can tweak to 14.33 or 14.35. Yeah. So I won't explain the details because there's some industry standard is 14.35. Okay. Okay. So the stochastic is supposed to give you signal on buy and sell as well. Like here, there are two ways to look at it. One is if it goes below the colored zone, which is below 20, go back up is one type of signal. Or the red line cross the yellow line here is another potential buy signal. Look at this. When it goes sideways in a tight range, it gives you a lot of false signal here. Okay, so remember, any indicator, most of the indicator when it's sideways is not reliable. And over here is overbought. It tells you, right, there's a signal crossover to buy. Right, crossover to buy. After that, all these sell signal are noises. Can you see that it just gives you unnecessary signal to get up? Right here, it asks you to get up here just because of this candle drop. It causes a stochastic to give you a false signal. Okay, just because of this candle drop. Then it goes back up, but it hasn't turned yet. Okay, so it's a lot of noise. Then over here, it asks you to buy back in because of this candle here. Because this candle is taller than the last few candles, so it thought there's a buy signal. Okay. In general, I studied the stochastic formula. The way it works is it takes the last 20 days, right? Stochastic, not 20 days. Let's say you take 14. Yeah, it takes the last 14 days. Let's say this is the last candle. It takes the last 14 days, highest point and the lowest point. Yeah, highest and the lowest point. And you see whether it has rebound from the 20%. Let me give you some idea here. I close this and I do a whiteboard. I will need to see whether I have enough time and I need to speed up a bit. Let me start a whiteboard so it's easier. Okay. So the way stochastic work is, so I need a straighter line. Right. So let's say this is a two range here, and you have a candle like this, right? The candle go down, go down, go down. Right. Then it goes back up. Right. Then it goes back down, goes down, goes up. Okay. Goes up, right? So there's a range of candle. So excuse me for my, because I misplaced my pen. So I'm using the mouse to draw. Okay. So let's say this is the last 10, okay, 14 candles. And now today we are starting here. Assuming today this is where we are. Okay, so how does stochastic work? It takes the last X day, highest and the lowest point. Right, highest and the lowest point. So this is the highest, right? This is the highest. Okay. And this is the lowest. And it compared this value, right? This is the today's price. It compared today's price with the highest and the lowest to see whether it is within the range, right? The range is here. Right. So this is the 20, this is the 80. So you'll see whether the current stock price compared to the last 14 days range, is it in the lower 20%, right? Or in the higher 80%. Okay. So when it originally is here and then it starts to move up from the 20%, it will give you a buy signal. Or when it's above the 80%, it come back down, it will consider a sell signal. Okay. So now when you see range bound, it makes sense. So as a signal, right? So when it's in the not a very tight range, the bigger range, right? So let's say you have a stock that is a $5 difference here, right? This could be this is a more expensive stock, let's say 100 and 105. And just making it bigger so that you can see the difference. And so this 20% range will be the 101. Okay, and this will be a 104. Okay, the red color here. Right, let's say a stock goes in this range, and this will be support. So it makes sense from this indicator signal when it's range bound. When it goes below and start to go back up, it could be a potential rebound signal. Make sense? And it asks you to buy here. And when it goes back up and turn back down, right? Below the 80% range, then it says sell here, buy here, sell here. That's the concept, okay? But the problem is when the range is very tight, it's too sensitive and it will give you false signal. And when it starts to go up like that, okay, sorry, wrong color. Okay, let's say the stock start to go up like that. The last 20 days, last 14 days will continue to go higher and higher, right? Will continue to go higher and higher and higher. So then that's where you keep getting the highest 20 will keep moving, right? Let's say the highest 14 days is here. The next highest 14 days will be here. Highest 14 days range will be here, right? So if your stock is here, it will forever in the lower range, okay? So probably I get a bit too technical here to explain why when the stock is trending up, it can forever give you the overbought and doesn't give you a turning point. So at the moment it goes up and it starts to turn 80% of this range in the last 14 days, then it will give you a sell signal, right? So this is not so important for you, but I just want to share with you the limitation is derived by the formula here. The limitation is derived by the formula where it just tells you when it bounces above the 20% of the range of the last 14 days is a buy. Okay, so when the overall trend tells you down, right? This is just the last one. Let's say the last 14 days is very, very bearish. And so happen it goes into the tight range. It's supposed to continue to go down. But because you see this tight range signal to buy, you go and buy. But bigger trend is still down, you'll be caught. It will be caught in the wrong direction. Understand? Okay. So okay, I will skip this because it's a bit technical on the formula already. Okay, so let me close this. Okay, so example here, I can see just because of this bounce and for the last 14 days high and low, right? This 14 days high, 14 days low, and this bounce up more than 20%, so it gives you a buy. Okay, yeah, so that's how it works. So if you understand the candlestick chart, you don't need to use this at all. Okay, then there's just a last part, parabolic SAR. And some are very simple this is a dot. This one also is another popular one. You know, the dot is, you see the dot is below, means it's bullish. But the moment the dot goes on top, it's a reversal. Right? Because of the formula. You see here? The dot. This is one of the formula indicator a lot of people like to use because they thought it's so simple, right? When the candlestick is above the dot, you continue to stay in the trend. But once it reverses, you're supposed to get out. But can you see here, just because of one candle down, and the next candle there's a tail, it reversed and you thought you were supposed to get out. But then after 2 days, the trend continue. Then are you supposed to buy back in? But when you buy back in, it's too late. The candle is, this reversal is caused by this candle. The moment you see it, it's already here. Then you're unnecessarily getting out and getting in back again. All right? Yeah, so I hope that explain why. You can actually look at a few stocks. This is only like some of, just now, if you can look at like YTL Power, YTL Corp, right? It will tell you the same thing, right? You know, these are some of the popular ones, okay? It will give you a lot of false signal, right? As you get in, get out, get in, get out. Whether you look at MACD, RSI, there's a lot of false signal, right? So I hope by sharing with you this, you don't unnecessarily get, spend too much time on indicators. Okay, so now let me move on to the next slide. Okay. So why does later on I have a Q&A, so I'll reserve a Q&A. Thanks, Kurt, for helping me to handle a lot of the chat questions. Okay, so since there's a lot of limitation, why does people like indicators then? Okay, why do you think people like indicator? Type on the chat. Yeah, the main reason is most beginners find it challenging to draw support resistance, especially for a choppy chart. Right? Because it's a lot of ambiguity. Right? It's right here or higher. A lot of people who attend our class, when they first draw, they feel very uncomfortable. Right? Did they draw it accurately? They thought it has to be accurate. And this comes with experience, right? And the more you draw it with the right thought process, you will get good at it. Right? So they thought that since there's a lot of ambiguity in support resistance, right? People like, oh, just tell me where to buy, where to sell. So a lot of people like indicators without understanding the limitation, and people can sell courses just like that. Oh, they can sell to a lot of people who don't know about the limitation. They can say, oh, this, my trading course is supposed to tell you, you just see this blue line, cross red line, you buy, cross the other way, you sell, or give you buy and sell. Very easy to sell a course, right? But that's not the right way, okay? Yeah, so just be aware of that. The next one is many people thought that indicators are holy grail. But in fact, standalone indicators is only 50 to 60% success rate, right? Based on the limitation I mentioned. Even when you combine a few, doesn't mean get better. Sometimes it get worse, okay? People like certainty. They like ease of decision making, okay? Just bear in mind, if you want to be accurate, it doesn't mean that you want to be accurate. Indicators doesn't give you the accuracy, okay? It just gives you some rough idea of the trend, that's all. Right? A gauge of the trend with a visual. Right? The good thing about indicators is quite visual, right? But when you have too many, it becomes very difficult to see. So I like EMA because it's an easy visual to see that, oh, the trend is still up because the price is above, right? But when I want to take action, I will go more precise on the support, resistance, and trend line, and also the relative high-low. So the more indicator you use, the more potential conflicting signal, okay? Yeah, so that's the reasons why I don't like to use all these other indicators, right? Other than the basic one like EMA. Okay, so now, based on the limitation, what should you focus on that, right? To me, everything has learning curve. Whether you want to use indicators, and so many indicators each one has its own learning curve, and price action has learning curve, right? So since there's so many limitations on the indicators, and there's more benefit to price action to give you the precision, why not you spend the time to learn price action instead? Okay, so it's better to focus on mastering the most powerful one, okay? And the smaller time frame you trade, right? When you are trading long time frame, right, versus short time frame, the shorter time frame you trade, the more important is going for price action, because indicators turn slowly. Okay, like I trade intraday as well, right? So if I wait for indicator to turn, it's too late, because like I can see the candlestick reaction very fast and the volume built up, right, to decide straight away. Right? So the more important the price action. So if you want to really master trading the financial market, you need to get great at strength, support, resistance, and candlesticks, and learn how to interpret candlestick reaction. Right, so price action gives you a better understanding of the behavior of the stock, right? It tells you, okay, there's a dodgy, there's a hesitation here, or today the momentum is a bullish, or today is a bit shaky. It goes up with a high volume or low volume, right? It tells you different thing. And it gives you more timeliness of action because indicators are lacking, right? But when you see that rebound on support, right, then that's where you can take action if the trend is up. So it's more timely. It gives you, when you draw support, resistance, and trend line, it gives you more precise where you should enter, right? Slightly above support, where you should put your stop loss, and also where is your profit target more precisely. Indicator doesn't give you this kind of precision. And once you get used to the ambiguity of the price action initially, it can be simple to use. Yeah. You can also supplement with some simple indicators, right? I supplement with the EMA, right? Because one glance you can see whether the overall moving average are going up, right? Then the rest of it I use price action. Okay, so this is what I recommend. And last but not least, right, you need to know that timing is not everything, right? Cannot just look at the chart and look at time, when to buy, when to sell. If you don't understand the big picture, or what stock you are trading, or what are the risks, then you can get gapping risks, right? Gapping means the next day, it gap down or gap up. The opening price is higher than the previous day close, right? Significantly higher or significantly lower, and you can risk a lot even if you have a stop loss. Okay, so the most important thing you need to bear in mind is there's no way to be 100% right in the market, no matter what you use, whether it's price action or indicators, because there are randomness in the market, that there are events that you cannot control, right? There are millions and millions of investors and traders out there, and they make decisions very differently from each other, and that create noise in the market. There are economic announcements. There are good news, bad news, right? A mix of macro news, right? War news, industry news, company-specific news, and all this mixed together is where the market noise is, and that's why there's no way to be 100% right. So the way doesn't mean you cannot trade the market, right? Trading is a probability assessment, right? For you to get great at it, right? So how should you win this trading career, right? How would you make money consistently in this? The more important one is you look at the big picture statistics, right? Not individual trade. So the shorter term you trade, the more randomness. You need to recognize that, right? Because longer term, the fundamentals will catch up, not the short term. Okay? Our goal is to increase the probability of success, right? How do we increase? Not just increase the recent trade success, but overall want to be consistent. The most important is you need to manage your downside risk. If you don't manage your downside risk, no matter how well you trade, what is your success rate, right? Just a few trades could spoil your whole account. Do you agree? Right? I guess some of you, if you're a seasoned trader, you had experienced that. So manage your downside risk. You need to have a cut loss point. I always have the cut loss point. Yeah. Then make sure your trade setup is a good deal. I only trade when the reward versus the risk is good. Minimum 2 to 1, right, for short term, and the longer one could be 3 to 4 times. Yeah, so depend on what time frame you are trading. Because one win cover 2 losses. So when one win cover 2 loss, you only need to be 1/3 right to break even. Anything more than 1/3, you start to make money. Right? That's the way to look at it, rather than worry, oh, is this win loss? Can I be accurate? You know, so you're too focused on the winning, you forgot to manage the overall success rate. Yeah. And measure your success in at least 100 trades if you're active trader. Okay, of course, investor is different. Okay, so these are, if you have a lot of trades, right, you measure in 100 because you cannot control the outcome of individual trades. Okay, limit the risk of each trade and also your concurrent portfolio risk, right? Just imagine, right, last Monday's situation where the KLCI also dropped significantly. What if it doesn't come back? It just happened that it come back. What if it doesn't? Right? I have experienced the various crises, right? After trading for 31 years, the 1997 Asia financial crisis, the Malaysia stock market, even the unit trust fund, savings fund, and also the what they call that, dividends fund, which are supposed to be more conservative, also dropped 50% during the 97 financial crisis, and some stocks dropped more than 70%. Right? What if you don't have a risk management and all your stock drop together? So we have a proper risk management for that. Okay, so make sure that not just looking at the chart, buy, sell, and then you buy unlimited. Okay, yeah. So to have a more comprehensive approach, right, to your investment or trading, right, just remember timing is just one part of it. Right? I employed a 4-step process. How many steps? 4. Okay, so what are the 4 steps? The first one is select. What is it? Select. Select what? Select the right stock. If you're trading up, you want strong stock. If you're trading one down, you want weak stock or ETF. I don't like to short weak stock. Okay, because when you short weak stock, right, and if the company is small, there could be takeover risk, and then you end up bypass your stop loss. Okay, so if you want to trade down, you need to use a ETF. Yeah, so I use fundamental to select the best company, right? The great companies first. I have 10 criteria to select the best companies. After that, I time it based on technical analysis. There are 2 ways I time. If it's for long-term investment, right, I also use valuation. I don't want to buy when it's excessive valuation, okay? But I don't use the basic one that people use because PE has a lot of limitation, right? Unless you understand the limitations of the PE. Okay, so I use valuation when it's for long-term plus technical analysis. For the short to mid-term trading, I use technical analysis, right? That means after select the best stock, I use the chart to time when to get in, when to get out, where to put a stop loss and profit target. And then I have protection, which is how much should you buy in one trade so that you can limit to 1% max risk. It doesn't mean you use 1% to buy the stock, right? But you limit when you hit your stop loss, it's only 1% of the capital. Some of you may think that, oh, it's 1% too conservative. Actually not. When you do a trend trading, we teach how to move up stop loss and add position. Your reward over risk may end up even 5 to 1 or 10 to 1 if you know how to do it properly. Not averaging down. A lot of people do the other way around. That means when the stock market comes down, you keep adding position. That is very, very risky. Okay, I don't have time to explain that. Never do averaging down. Right? I know the unit trust industry do that, but it's a different concept altogether. Right? If the stock go lower, don't keep buying. You're digging a big hole for yourself. Okay, have to wait for trend reversal before you add, and you're supposed to get up first. So we have a proper risk management, individual trade risk and concurrent portfolio risk. Yeah, that means if there's a systemic risk like last Monday, everything goes down, or there's a big crisis, continue to go down, what is your maximum risk? Okay, and last but not least, once you learn how to protect, then you can multiply. How to multiply? That means you can use lower capital, like instead of stocks, right? I think some Malaysia broker may give a stock with margin, right? Or if you know how to use CFD or options, right? Those give you better leverage. Okay, but make sure that you master the foundation first for trading with stocks before you go into options. Like Malaysia, there's warrants, right? Warrants is a type of call options. Okay, yeah, so that's the step by step on how you proceed with this, right? So we have a systematic approach on this. But if you don't have a systematic approach, do you think you can repeat the success? Right? That means every day the way you look at the market is different, right? The way you analyze the stock is different. You don't have a systematic way to get in and get out. And worst thing, a lot of people don't know what's their trading time frame. They just know they want to make money. They don't know when I enter this stock, is it for long-term, mid-term, short-term, or intraday? So end up when things go wrong, they don't have a clear entry exit rule, right? Every trading style need to have a clear when to buy, when to sell. Okay, don't mix them up. Sometimes people say, oh, it's supposed to be a 2 week trade. Okay, swing trading from support resistance. End up the balik, right? Go the other way around. Then say, oh, never mind, I don't want to cut loss. Just leave it for long-term investment. Okay, that's the wrong way to do it. You will never be consistent that way. You need to have a systematic approach. Before that, you need to know what your trading style is, right? Clear out the trading style. Or this trade is for what style? Okay. Once you have a systematic approach, then you want to build up the versatility, right? We have a SBS framework. Systematic, one of the differentiator of our approach is systematic. For example, we have a STPM process for each 4 trading style. Each one has its entry exit rules. The second one is versatile. Like sometimes the market is volatile. You don't want to keep positions overnight. Like for example, let's say tonight a CPI announcement, right? So there could be sell on good news. It could be, the inflation goes up a lot, then it causes the market to go down, right? So in times like this, where it's a big market mover, you want to at least lighten your positions, or if hedging, you can hedge your positions, right? Otherwise, you trade intraday, right? You don't keep overnight, right? So or overall, you just stagger by, right? Gradually, so that in case it goes the other way around, you don't lose so much, because sometimes it could go in your favor, right? As the announcement is over, then you lighten your position before, and announcement is over, then you gradually add back in. Okay, yeah. So that's how we can manage it. So it's very systematic and it's versatile. We use different trading styles when it comes to different market sentiment. And last but not least, you need to have a safe approach. Okay, so without a safe approach, then you will never be consistent. Okay, the psychology is very important as well. Okay, so that's our biggest differentiator, right? Systematic, versatile, different trading style to stand by for different market. When the market is trending, you want to trade trend. Okay, because that's the most lifestyle. Okay, yeah. And when there's a big crisis, then you focus on investment, right? So because then there's a lot of jam. But investment deal doesn't come so often. It could be in 1 year you have 1 to 2 bigger pullback, and a few years once you get a big bargain, right? Other than that, you don't have a lot of deals. So the rest of time you trade when there's a trade opportunity. So if you are clear on the different trading styles and how to get in and get out, then you will be able to have the best success. Okay, so last but not least, I want to remind you that trading is not a get-rich-quick scheme. Okay, if you want to, you can get, you can make a lot of money in the short trades, in just a few trades when you're lucky. But if you trade long enough, you may not be able to sustain if you don't have a proper methodology. Okay? So it does require, if you want to be consistent and really grow your money, to become financially independent, or you can even trade for a living, it requires commitment. Right, you need to put in the effort and discipline. You need to build up systematic skills. Right, first you need to ask yourself: do you have a systematic process? Right, okay, what style you are, and how do you screen stops? How do you time when to get in and to get out? What is your money management? Right, when you're wrong, and also when do you just let it hit stop loss? When do you just manually exit? In what condition you manually exit? All these need to be thought through, and then you need to practice. Yeah, like the charts. Once you practice more, then it will become very easy for you, right? It just take, if you're doing trend trading, it just take 15 minutes to look at the daily chart trend, unless you're trading intraday. Yeah. The most challenging part for most people, after they learn the processes and are able to execute it, is actually the discipline, right? How many of you agree, right? Discipline is the tough part, right? The one to cut loss. How many people are still hanging on to the top growth, right? Or the harta lega after the pandemic is over, right? Why? Because cutting loss is painful to a lot of people. And it's after the fact they say, oh, already lose so much, how to cut, right? I always hear this from people, right? So then they will keep on to the losing trade forever. They could have just sell it off and buy a one that they screen from scratch with the right thought process, and that one could be the one making back the money for them, rather than stock to this stock. Okay, so that's the psychology part. And also you need to control yourself from buying too many, too much. So I also want to remind this, technical analysis could be ambiguous for a start, but the more you train, the more you practice, right? And understanding the right thought process, then you can actually master it. Other aspects is also important. Remember, what we need to do to improve our overall success rate and consistency is look at how can I increase my success rate if I'm trading up then, right? I want strong fundamental stocks when I want to trade up. This company should be making money and they have a sustainable growth, right? Then the chances of it go up is high. Then when I look at the stock chart also, it has a nice trend up, right? Then I want to factor in case I'm wrong, I have a cut loss point, right? And when I win, I can win at least 2 to 1, right? For short term, right? For longer term, it's more than 3 to 1, right? So with this, right, when you look at 100 trades, overall, you will make money. Okay, you can handle a lot of hit stop loss and still, overall, you can still make money. Okay, so that's why it's important to have stock selection and money management. Of course, the psychology to follow it is very important, right? You can learn everything, but if you don't follow, it's also no use, right? And so that's all for my presentation. So I hope that you learned from, you benefited from this. Okay, so now I'm open to Q&A.
Yes, thank you so much,
So I'm a
Catherine,
bit
for sharing with
behind.
us.
So I probably have another
10 minutes.
10 minutes for Q&A.
Yes, thank you so much, Catherine, for sharing with us decoding market timing. Should we
Yeah.
use price action or should we use indicators?
Yes.
So right now we have learned a great deal about the limitation and the drawback of indicators. And the conclusion today here is that, price action is more for short-term trading and it's more reliable and it is the most powerful strategies for us to understand the momentum and the psychology in the market. So if any question to ask our speaker, Catherine, today, please write your question in the Q&A box, yeah, not the chat box, because chat box, there are a lot of questions already. Please write them in the Q&A box, right? So the first question I see on my screen is from Lim. So Catherine, we know that you are a professional trader. So his question is that, what kind of percentage return a year is considered good for professional trader, day trader?
Yeah, first I want to ask what trading style first. Yeah, can you
Day
start
trader.
Trading style? Day trader.
Yeah, day trading.
Day trader is between 5 to 10% per month.
5 to 10% per month.
Following money management, not gung-ho trading.
So in a year would be about 50 to 120% return.
Yeah.
Would be considered a good
Yes. So,
day trader.
but it takes longer to master, right? Most people take a few years to master, like our top traders. And the success rate, there's two parts, right? One is the percentage return, the other one is the success rate. Because short-term trading has a lot of noise, I did research on the top traders in the world as well, right? There's a lot of interview top traders books. Steve Cohen, one of the professional trading fund, his top trader is only 63% right out of 100 trades. And majority of his traders, 50 to 55% right only. But they still make a lot of money, right? Because they have a risk management, they cut loss when they're wrong, and the reward always is good. Okay, so a lot of people thought that you need to be 80% right and above considered a good strategy. The answer is wrong. And so we do have our top traders in our team as well, which get like 60 to 70% success rate. And the percentage return per month is between 6 to 10%. Yeah, of course, these are the people who are on the niche, they are disciplined, they are willing to do a lot of paper trades before they trade live. Yeah, so that's for intraday. If you're looking at trend trading, is about 30 to 60%. Of course, not every year is trending nicely, right? So if you learn how to top up positions on a nice trending year, move up stocks, add positions, there are opportunities to get more than 100%. But I want to be conservative here. Typical year could be 30 to 60% for trend trading. If you aggregate over 10 years, some years are good, some years are not so good. Long-term investing, typically on the conservative side is between 15 to 20% if you follow the Warren Buffett style, right? If you follow growth stock, it can be 20 to 30%. Yeah. As again, we are looking at the 10-year average here. If you select the specific stock, right? Sometimes let's say you hit one of the a big runner like in the semicon, right? It could be more than 100% a year. But I want to be realistic to a lot of you. I don't like to set the too high expectations because you need to manage your greed. Okay, do I answer your question? Like intraday trading, why I can say that intraday trading is 5 to 10% per month. If you do 20 days, like let's say every day you trade, right? So average 20 nights, right? 20 nights, and you are half right. Okay, out of the 20 trades, you only have 10 rights, and you get 50% success rate, right? That means when you, and also 2 to 1 rewards. When you win 2 times of your risk. Okay, you need to have a stop loss. Okay, you win 2 times of your risk, then 1 win cover 2 loss, right? Yeah, with 50% success rate, 20 trades in a month, you get 10%. Mathematically, you can calculate that. Yeah, but most people, when they start off, they don't get 50% in intraday because there's a lot of noise. You take a few years to master it, not 1 year, not a few months. Whereas trend trading investing is or swing and trend is much easier to master and less emotional. But intraday is worth to master if you have the time. You need about 2 to 3 hours a night, yeah, to do intraday trading. Okay.
All right, thank you so much, Kathleen.
Next question.
So the next question is by Lee Swan. Can we select stocks based on target prices by analysts? But how do we determine the time frame for us to reach the target price?
Yes, I don't do that. The target price by analysts just give you a gauge on how much more room it can go up. Normally, I want to know why they say that. And I don't want to rely on 1 or 2 analysts here because it could be biased. When there's and I always prefer that you understand the company first, right? What can drive the price to go up to that level? If you know the profitability and the growth drivers, right? The EPS growth, then you can actually project the target price yourself. Yeah, in fact, we have, of course, we show people, those are more advanced, like how to project like the analysts. Analysts normally give you a 1 year target. When they say, like, although they don't specifically say it's a 1 year target, but most of the time it's sort of like an industry standard. They will say, okay, it can go up to this price. Sometimes it could be half a year to 1 year. But because when they say that, a lot of people chase after it, sometimes within the next few months already reach the target. You have to understand the assumptions behind the target. Some analysts are more aggressive, some analysts are more conservative. And if you don't understand the assumption, when the assumption change, the whole forecast can change. Like example, there are a lot of great forecasts before the pandemic, right? So when the pandemic happened, do you still hold the forecast true, right? Or when the China opened up, a lot of people revised up the forecast, like after the 3 years lockdown. But after that, it seems like the consumer spending are not kicking in as fast. Then, things change. Right? So when you see a target, it's best for you to understand why it can be so high. Okay, otherwise you don't know how to react to it. Yeah. You can still trade technically. You can look at the chart and see whether it makes sense. Sometimes, I don't say all the time, right? Sometimes people may put a high target in the market, especially when it's this 1 or 2, is when people want to sell. They put the news in the market, like there's this target price. Unless there's a lot of consensus, unless you know what is the growth drivers and the current valuation is not too high, you need to look at current valuation. Right? Has it factored in the growth yet? If it's yes, then it may not go up higher. Okay, I don't like the target price that's just like one, like target price here, but don't explain what. Yeah. I mean, I'm a strong believer on understanding, create a strong foundation, right? Yeah, you will not go far if you keep relying on analysts giving you the target price.
All right. Thank you so much, Catherine, for addressing the analyst related questions. So the next question here is that, Catherine, we know that you prioritize price action strategies above the indicator strategies.
Yeah.
So which do you think is more important? Do you think candlestick pattern is more important or chart pattern is more important?
I would consider candlestick as part of the overall chart patterns. Candlestick is still part of the price action. Why is it called price action? Right? How the stock price react to the support, okay, or the resistance. Like let's say the stock price right now, right, when market is open, right, it's moving like this. Let's say you're looking at intraday right now, it may be like that. Okay, so if they coming down, before coming to the strong support, there's already buying going up. Does it tell you something? Before coming to the support, right? Let's say there's a round number support. Let's say Malaysia stock, right? Let's say a $10 stock, right? You expect that it may come down to the support like $10, right? Then go back up. But at $10.10, right? It already rebound. It cannot even touch $10. Does it tell you something? Right? That means there's a lot of queue there wanted to buy at 10.10. That's called price action. I want to look at how the stock price react to that. Before coming to the price, there's already queue there. Because there's a queue, it doesn't come down to the support. Right? So, and how much is the bounce? Candlestick tells you it closed higher than previous day, right? Or there's a doji, it means there's a hesitation, right? A long doji means like, go up, go down, then it's close. There's the tug of war. Small doji means there's a hesitation, right? A lot of people are wait and see. Long bullish candle shows conviction. Long bearish candle shows very bearish conviction. So candlestick tells you what's happening in the market in terms of the price. Yeah. So I use it together. I mean, support, it's more like the price, which is the candlestick reaction, not just the candlestick when it's closed, because I trade intraday as well. I look at how the intraday behave as well, right? Are there a lot of buying, selling, a lot of selling towards the close or not, right? Or it closed with conviction, right? No selling towards the close. That also tells you something.
There have been two questions asked you. How do we draw support and resistance?
You draw based on the most touch point. Yeah. So
it can be shadow or it can be the body, right?
Okay, if it's a support, I use the tail unless the tail is an outlier. You don't understand why the thought process is more important, right? Let's say this is a support, right? You want to draw a support. What's the purpose of support? You want to know where people want to buy, right? Yeah. So if you know what the support is for, is you draw a support to know where people want to buy. So you look at in the past, where is the place that reached that point and rebounded? Okay. So do you think it should be tail or body? Right? Yeah. Type on the chat. If the purpose on it is to know where people want to buy, right? So if you look at the body could be the close or the open. Okay, depending on the shape, right? So the tail is important. The tail shows it come down to this price, the support, then it goes back up. But it's because the U-turn is here. A lot of people buy here. But unless this tail on this day is the outlier because of some noise. So I would connect as much tail as possible. And normally it close to some psychological round number, like the tens, right? Like $10.04 outlier, then I won't draw the support there. Yeah. And remember, the support resistance is a range. You don't have to be so accurate because you will be buying slightly above the top. You won't be buying exactly as support. Yeah, especially if the support round number, I won't buy there. Okay, so the concept is the more bounce, the better. Okay, the close is important, the tail and where it closed. But when I want to draw a support, I will draw on the lowest point. Yeah, because the lowest point is where it touched and rebounded, and as many touch points. Right? If it's only one tail, then I won't draw. The rest is above, but only one tail below. I won't move it down to cover the tail because it's an outlier. Okay. Yeah.
All right.
Resistance is the other way around. Resistance, I draw tail based on the tail on top. Yeah. Okay.
All right, thanks, Catherine, for sharing with us the tips in drawing support and resistance.
Yeah.
So today we have learned a great deal about decoding market timing. Should we use price actions or should we use indicators? So today, what we got from Catherine is indicator is less important as compared to price action. So that's what we got away from this session today. So that's all the time we have for this session and for the Q&A with Catherine. So ladies and gentlemen, you just listened to the founder and chief trainer of Beyond Insight, who is Miss Catherine To. Thank you so much for sharing your time with us today.
Okay, so we have another sessions which is on the macro industry, the 40-30-30 in the future seminar. So if you're interested, that will be my last seminar this year with Bursa.
All right, so it is happening
11
on
September. Yeah.
Yes, 11 September. All right, next month. If you want to catch Catherine again, please block your calendar on 11th September. All right, so that's all for this session.